Hey everyone, it is E-Money, your BFFF, best financial friend forever. Hey, I don't know about you, but when it comes to investing, there is a lot of confusion out there. And I get it, because when you go to talk to somebody, whether doesn't matter who they are, I think everybody has their own biases when it comes to where to put your money to grow, to appreciate, and then eventually to be able to utilize to live however you want to live. So we have to look at investing, through the bias lens, and really look at the different strategies and categories that are out there, and just make sure that we understand the pros and cons of each, so that when we're developing our own investment strategy, it's not just based upon our own bias or somebody else's bias that we heard. So we really do, I think, a great job of going through all the different pros and cons of different types of investment strategies. And we keep it simple. It's going to talk about, the stocks and bonds, insurance-based contracts, and real estate. So I think you guys will really enjoy this. And let me know if you guys enjoy this, and whatever other topics you'd like us to talk about, because really we are on a mission to help as many healthcare practitioners and owners as possible achieve financial independence. And with that being said, I want to make sure that if you do need help, right now, go to our website, make sure that you download as many of the materials that we have on there that are built for you. And I also want to make sure you guys schedule a call. So if you have questions, if you have doubts, if you have concerns, if you're not sure about things you need to do to be successful financially, that you're actually getting some help for that. Okay, enjoy the podcast, and I'll see you on the next one. What is today? It's almost Halloween.
Is Wednesday, the 30th.
A couple more days to Halloween. You going to dress up as anything?
No.
Nothing at all?
Nope. Nothing. I'll pass out candy. I will do that.
Mm-hmm.
But.
Are you one of those guys that gives out really crappy candy? Just like the most awful candy that there is.
Like a little bag of peanuts.
If that.
Yeah.
Give out like those little Milky Way things that just get stuck into your teeth that nobody likes.
No. I try to give like good stuff. Last year I did, at least. This year I haven't bought anything, so
like Reese's Pieces and Captain Crunch and all that stuff.
Yeah, I got to go to the grocery store today because I don't have anything.
Well, you better start, making some money to do that and investing properly, so I can afford candy. So you can afford candy. Yeah. So I thought we'd broach the subject of investment strategies today, because it's always seems to be something that people enjoy and are as popular and want to talk about. But I don't know. Let's get into. I want to talk a little bit about, first off, the biases that people have on their investment strategies.
Okay. I see that.
And when I say biases, and maybe it's not just necessarily like a bias, it's for a number of reasons. You can have a bias for a number of reasons, because number one, there's a financial reward for you for it. Okay. It's just part of your business model, which is fine. Just make sure you tell people that, or you've just had really good experience with, a certain type of investment strategy.
That's what that's what I find. And I see biases of all types, and a lot of times, 90% of the time, it's as simple as it goes back to people are comfortable with what they know.
Yep.
I have some clients that their bias is all they want is real estate. I have clients who all they want is to buy index funds. I have clients who all they want to do is put money into life insurance and annuities and safe vehicles. And that, can be a bias too, where you're too conservative. So it's across the board.
Yeah, it is. And you have three very different industries right there that provide very different benefits to individuals.
Oh, yeah.
And, it's pretty obvious to me that, you're never going to find a real estate agent or someone that loves investing in real estate that's most likely going to have anything positive to say about, like, say, insurance contracts.
Yep.
Right. And you're certainly never going to find someone that is like a Series 7 broker, or someone that is just, or like a real traditional fee only RIA, where all they do is public securities, stocks, bonds, ETFs, whatever that looks like.
Yep.
That's ever going to have a nice thing to say about insurance contracts.
Yep.
Very rarely. I think you're going to find that.
No, absolutely.
And I don't know about you. I think that's a problem.
Yeah.
I think that's a problem, because you have, the public out there who by and large doesn't really understand investing, doesn't really understand these different investment strategies, and is getting their information, like the pros and cons, from people that clearly have a bias between all three of them, whether it's real estate, whether it's stocks and bonds, or whether it's insurance contracts.
Yep.
So you got to go on
biases against all of them. Yep.
Yeah, you're gonna go on. So I think we can all agree that there are cons to each of these strategies. Yeah.
Oh yeah. Totally agree.
Yeah, there are things that make these strategies look unattractive. That's just there's
good and bad to everything in life.
So your
investments are no different.
Yeah, you're gonna have that. Like, I'm seeing a lot of people right now, just because I'm just kind of intrigued and fascinated, following the Bitcoin story. And you right now you see very few people with any cons about that as an investment. Very few.
Very few. Yep.
Which is okay. That's great, but there are some, for sure. There are some. And obviously we're not getting in a Bitcoin debate today, but I think that you have to, like, make sure that you're separating out your biases, although it's hard, because even as the kind of work that we do, I'm sure you have biases. I know you have biases.
I do.
I know you have biases.
I definitely do.
And I don't know that necessarily reflects on how you give advice, though. I don't think it does. I think for the most part, you are able to, like, separate out what your own personal biases are than what this client probably needs.
Oh yeah.
You
have to be able to do our job.
Exactly. So I thought we would just kind of break down today, like, some of the talk a little bit about the pros and cons of these different investment strategies that are out there, at least as a broad category. Okay. Because if we try to, like, nail it down into, all the different variances of these different types of strategies, then we can get into the weeds. That's for sure. But from our perspective, I think if you're going to be an advisor to people, you cannot have an investment bias. You have to be able to look at something and say, okay, there is a need that this client has. This other investment may provide some of it, but this one strategy has just proven to be a little bit better at this.
Yeah.
Okay. And you got to be open to, like, and willing to do that. The issue is that some people won't do that because they're simply not compensated for it.
Yeah. I mean, you're dead on. I mean, you're not gonna. If you go to somebody who only does insurance, they're only going to push insurance. If you go to somebody who only does stocks, they're going to push stocks. I mean, they have, even if they don't mentally realize it, they're going to push you to the area where they are compensated. That's life.
Yep. It's for sure. So it's just a matter of being, as a good steward of money, you got to be able to look at these different strategies and say, what are the pros? What are the cons? And most importantly, where do they fit into my overall strategy? Because you know what? Real estate may not fit into somebody's strategy.
Yep.
It just may not, insurance contracts may not be fit into someone's strategy, or they don't qualify them. It just may not. Okay. Same thing with stocks and bonds. They just may not fit someone's strategy. So you have to be able to look at these things and say, okay, where where are the pros, where are the cons, where do they fit in, and how do I use them for my benefit? So let's I'm going to bring up this chart then, and we'll go over some of these. Share. Can you see that?
Yep.
Okay. Hopefully everybody can see that. So this is a slide that we have as part of a presentation that we've done where we're looking at pros and cons for different investment strategies. Now, when I say investment strategies, look, I mean, if you don't have any money to start with, it's really tough to invest. Yeah. So the precursor to having money to invest, which sounds like a really, like I have to say that, but I guess I do, is that you got to get a lot better at acquiring money and you got to get a lot better at controlling money.
Yes.
Because if you're not good at acquiring money and you're not good at controlling money, then there's not going to be a conversation of having money to invest. It's just that simple.
Yep.
So get good at those other two skills first. And then when you've set up a system where you're able to capture money that goes into some kind of an investment account, then we can start talking about this. But I don't know how many owners I've seen that are like, where they're just like have all their attention on their investment portfolio at a 5% profit margin.
Yeah.
You know?
Yeah. No, you're not wrong.
With $10,000 in their bank account.
Yep.
It's like, dude, what are we even talking about right now?
Yep.
Okay. You got a much bigger problem. And that problem is that you don't know how to acquire and control money very well. When you're able to save $100,000 a year in your investment account, come talk to me. You know, come talk to me.
You got to, at least for our client base, you have to be able to take that cash flow, call it, and move it somewhere where it's not going to get spent.
Yep.
Like it just goes back to our whole wealth building strategy.
Yeah.
It's a different conversation, but at the end of the day, the clients who invest the best are the clients who stack money in the bank accounts the best.
Yeah. It's simple.
So
you have to have money to invest.
Yep.
So it's a simple thing. All right. So that being said, let's go through the pros and cons of each of these different strategies and explain exactly what they are and what they aren't. And, see if we can come to some agreement here. You want to start with your favorite?
Sure.
Which one's that? Geez, let me guess.
Bitcoin.
Let me guess. Insurance contracts.
Stocks and bonds.
Stocks and bonds. Why do you like stocks and bonds so much?
Because I know that if I hold a portfolio of stocks and bonds,
yep,
and I ride out the market downs, which do happen, 2 or 3 times a decade, but I know I'm going to come out ahead.
Yeah.
And I mean, past returns, you can quote 1,000 different benchmarks, but I think it's pretty well established that, the U.S. stock market, not the bond market, generates about 8% a year on average, 8 to 9%. So I think the returns are attractive. I think, the liquidity aspect is attractive. They're easy to convert to cash. But, the biggest cons, I know we say interest rate risk. Of course, interest rates affect the market. Public sentiment risk.
I don't know about that. It doesn't seem like they do anymore. It doesn't seem like anything affects the market anymore.
Well, but think about it. When interest rates were going up in 2022, the market was negative 22 or 24% that year.
Was it?
Yeah.
Was it that bad that year?
Yeah.
Wow. It was down 22% that year?
The S&P. Yep.
Yeah. Wow.
So, yes, interest rates do affect the market to some degree.
They typically do to some degree because think about it from a perspective, guys, of the cost of money. which is basically what the interest rate is.
Yep.
Like if I'm going to borrow, and again, money in this money really, it doesn't have an effect on the ability to invest in it unless it's in motion, right? Like money sitting in an account doing nothing by itself. Money has to be in motion.
Yep.
Right. And when there's a lot of money in motion, then that's going to obviously be beneficial for stocks and the equity markets.
Yeah, but I mean, I find the single biggest con to stocks and bonds is clients themselves, and they self-sabotage, right? Because everybody wants to put money in when the market is going up, and everyone wants to naturally pull out when it's going down. And
we could probably add that as a con, right? Is just the is the self-sabotage that people have when it comes to this. And it really doesn't matter how well someone has done in the past with this. It just takes one really bad market, and I've seen people just cash it in.
Yeah, and that's the problem is natural human, buy high, sell low is like we feel like we're protecting ourselves, but it's literally the exact opposite of what we're supposed to do, factually speaking. We're supposed to shovel money into the market when it's going down and take our profits when it's up.
Okay, dude, you have close to 100 clients. How many of them have actually, when the blood has been in the streets, when the market's been down 20, 30%, how many phone calls did you get from people who say, I want to buy more right now?
Like maybe I can think of one.
There was one? I'm surprised there was one.
I have one, and it was a client who had sold their business, so there was a lot of cash, but there was one. Yep.
One.
But I got a lot more calls about clients that wanted to either stop putting money in or slow down or pull out or got a lot more than one of those.
Yeah. And it's like at that point in time, someone's like systematically putting money in and you're actually buying things on sale. But the just natural reaction is going to want to pull out. Right. Yep. So public sentiment risk is pretty high. Interest rate risk is definitely there for the cons of investing into public securities. I mean, this is that is a con. Like you're going to see volatility and fluctuations in your account values.
Yep.
And I don't care how masterful somebody is or how many, stop losses they put on there or whatever they try to do to, mitigate the losses. If we're in a really, really bad bear market, everything gets slaughtered for the most part, right? Yep. Everything does.
Yeah.
Gold, silver, bonds. Like I every time we've had a really big sell-off, I don't see like, international stocks are up 25%. Aren't you so glad that portfolio is doing well?
No, I mean the reality is the U.S. market dictates the global market to, there's a strong correlation there.
Yeah. So the fantasy that most people have is that like as long as I have a diversified portfolio, then that's going to help with the volatility. It may to some degree.
It will help.
I mean, maybe large caps don't go down as much as, some other areas don't. Okay. You're still going
You're still
down.
going to have down years.
Yeah. You're going to lose money in those down years, or you're going to lose value. You're not going to lose money until you sell it. You're going to lose value. Okay. So that's a con of that. The pro, I think you've already talked about that. As much as I've tried for this not to work on the public securities, it is hard for me to have a counter argument that it has not provided high historical returns.
Yeah.
There has been capital appreciation on those. And when we say potential income, I think we're more going towards like the bonds and the dividend paying stocks.
Yeah. I mean, bonds can pay you interest payments and dividend. There are stocks that pay cash dividends, which is basically interest payments.
Yeah, exactly.
So you can generate pretty reliable, stable. reliable and predictable amounts of income in the correct type of portfolio.
Yeah.
So,
and so, how you set up your portfolio, the allocation of that, is it important? Of course, but I think by and large, people overthink this, way overthink this when it comes to that. And just know you're carving out a portion of your retirement that's going to be in marketable securities. Okay.
Yep.
And these are publicly owned stocks or bonds, or they're held in some kind of an ETF or something like that. But that's it. Okay. And you're going to have wild fluctuations. But you know what? If this system that we're in right now continues to operate, then, that's what you should be able to expect.
The system's
going down. Anyway, I didn't say that out loud, did I? Okay.
The system.
You're just part of the system, Gersch. Okay. So let's move on to insurance-based contracts.
Your favorite.
Okay. It's not my favorite, actually.
Your baby.
I've seen many people benefit from this.
I agree. I have to.
Many people
I'm just playing devil's advocate, but
yeah,
absolutely.
So if stocks and bonds are held generally in some kind of with some kind of a brokerage firm, custodied at a large brokerage house like Fidelity or TD Ameritrade, who are some of the other ones? Schwab,
Vanguard.
Some of these. Vanguard, some of these really big investment companies. Then you have what are called insurance-based contracts. Now, insurance-based contracts are not offered by those big investment companies.
Nope.
Maybe to some degree.
Some of them do, but not really.
But by and large, the insurance industry is a completely different financial institution.
Yep.
And the insurance, by definition, is a transfer of risk from some kind of risk that you don't want to take to a insurance company. Okay, car insurance, auto insurance, homeowners insurance, whatever it is. Okay, and there are insurance companies out there that will handle certain and will give you certain investment opportunities as well. Now, generally, that's done through cash value life insurance and annuity contracts. Okay. And, I don't want to spend a whole lot of time even going between the two, but just know that they are. A contract it's a contract.
Yep.
Like your definition of a contract, I'm sure all of you guys have had contracts before. It's written. There is someone that offers the benefits and someone that gets the benefits. There's a give and take. Okay. I'm going to give you this in exchange for this.
Yep.
Okay. And there's promises made in that contract and, everyone moves on. All right, that's very different than public securities. Very different. There is no contract when you invest in Apple. There is no contract than when you invest in, another company.
Yeah.
Okay. So the insurance contracts the insurance companies are basically saying, hey, if you give us X amount of money, we're going to provide certain benefits for you.
Yep.
Okay. What are those benefits typically that you've seen?
Oh, I mean, there's some great benefits on insurance contracts. I mean, there's insurance can give you guarantees. The stock market cannot give you guarantees. And the two best guarantees the two main reasons that I use life insurance as a quote unquote investment is number one, long-term care. Most of these policies come with what's called an accelerated benefits rider, where you can pull from your life insurance amount while you're alive to pay for long-term care. So that's huge. Obviously none of us are getting younger and all of us are going to age. And then secondly, some policies have what's called a lifetime income rider that takes that investment bucket and basically turns it into a pension where you get X amount of dollars every month guaranteed until you die. and those dollars are tax free.
Hey man, but you just told me that if I put my money in stocks and bonds, I'm going to get higher historical returns and all these things. So why wouldn't I just do that? Why would I put any money in insurance-based contracts?
Because of those guarantees. Returns aren't everything. I mean, returns are very important, but
it's peace of mind.
Peace of mind, right? You don't know. I guess the simplest way I can put it is you can look at your portfolio and you can say, okay, I'm just going to give an easy example. I have $1 million, so I can pull out 50,000 a year, 5%, right? Historically, you're right, but there's no guarantee that will work out. Whereas I could take that same $1 million that's in an insurance contract and I could tell the client, you're going to get 50,000 until you die. There are no ifs, ands, or buts.
Yep. There's predictability on that. Yep. There's 100% predictability on that. And regardless of what everyone else says about, well, you're not keeping up with inflation, you're not doing this, you're not doing that. Some people don't. I mean, it's predictability of income.
Predictability. Yeah. I mean, that's worth. It's a benefit that you can't put a dollar amount on. You know?
And I don't see anything wrong with having a bucket of your portfolio, your household portfolio, where you have guaranteed income coming in. And those are going to come basically from two sources: insurance contracts and Social Security.
Yep.
And I would probably even say insurance contracts are more guaranteed than Social Security at this point in time. So it's as you said, we're going to get guaranteed income. There are going to be some tax benefits because the insurance companies on certain types of products have been able to, create, methods in which they can, create tax benefits.
Yep.
Basically through cash value life insurance and the mechanism of policy loans, which allow people to access their cash in a quote unquote tax-free manner. It's complicated, there's pros and cons to it, but it is there and people use that.
Yep.
And there's liquidity there. Yep. On the annuity contracts, it's basically just, I never have to worry about running out of money. I'm going to get a paycheck. Even if my account exhausts, I'm going to still get paid for the rest of my life. What's the downsides?
Lower returns during the compounding years. The insurance or the annuity contract is, if the market's growing at 8%, the annuity contract's probably growing at 4%. So
yeah, you're going to get lower returns.
Yep.
Because the insurance company has to make sure the promise they're paying you all your money back. So they have to invest in things that they have faith in that are going to provide that. And by nature, those things are not going to be, super speculative investments.
No, insurance companies are regulated in how they can invest. And it's basically, corporate bonds, municipal bonds, U.S. treasuries, mortgages. It's all fixed income products. They're not investing in the S&P 500 or Tesla, or they're not allowed to.
No. So, it's big. It's generally, like you said, it's a heavy on bonds and mortgage and real estate, and mortgage-backed securities, and other types of real estate as well.
Yep.
So that's and then the other con would be if you surrender a policy prematurely, they're going to ding you if you're in a window of that.
Yeah, I mean, life insurance and annuities generally have a 7 to 10 year surrender charge schedule where if you cancel the account, call it, you get a percentage penalty.
Yep.
So,
okay, good. And then the last one's real estate.
Yes.
All right. And I can tell you right now, like we offer, I don't know. I mean, we certainly make recommendations for real estate. We don't have any method of getting paid on it though. Do we?
No.
And
we don't.
Nope, I don't. But we still make recommendations for it.
Oh yeah, I talk about real estate all the time with clients.
So, what is it? What have you seen the pros be for real estate?
I mean, cash flow. It's right there. I mean, that's the biggest one. Is
this is more for healthcare owners in their buildings that they own.
Okay,
like that's where I've seen them produce the most cash flow. Yeah.
Yeah, I mean, you've got. I was just having this discussion this morning with someone, but I mean, you've got a call it a 30-year career, right?
Mhm.
And over those 30 years, if you own a practice, it needs to be housed somewhere. So it's either going to be in a space that you lease or a building that you own.
Mhm.
And if you lease for 30 years, it's okay. People do it and they're successful, but how many hundreds of thousands, if not millions of dollars are you throwing out the door to your landlord?
Yep.
Versus if you owe, you have to own, excuse me. Yes, you have to take on debt. Yes, you pay interest. Yes, 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 yes. But you're building equity for yourself, and you're going to have that asset to sell or lease to somebody when you retire.
Yep.
So
100%. I mean, that's where I think most of our clients have had the most success with real estate.
Yep.
Is their location buildings.
Yep.
Everything else they've done, some people have had success in rentals, some people have had success in Airbnbs. I've seen it be sparingly.
Yeah. Residential.
Yeah, not much in the residential area. It's
I have
mostly
very few clients who have been successful with residential. I mean, there just the simple reality for our client base is picking up 1, 2, 3 residential properties that you rent out. It sounds, I think people like the thought. I think people just like to say they own real estate.
Mhm.
It's sexy per se, but if I'm honest, I would say probably 7 to 8 out of 10 clients who have, less than a handful of rental properties, they end up selling them because the hassle isn't worth the income.
Which is the biggest con, I think. It's a self-management risk.
Yep.
You have to manage this stuff yourself. Obviously, you can go through a syndicator or an operator and have success that way. And I've seen people do that as well. But
that's different.
Yeah. Anytime you get into real estate, there's always going to be leverage risk, whoever it is, because most people are going to borrow for real estate.
Yep.
And the positives would be, capital appreciation. Obviously, there's some good tax benefits that you can flow through on real estate, and that it should produce cash flow.
Yep.
But again, it's not guaranteed income. Okay. And it's not liquid at all, like stocks and bonds are. So you kind of see the pros and cons. We probably should put lack of liquidity there as a con as well.
Yeah, that's definitely the biggest. I don't know the biggest, but that's definitely a con of real estate is you can't easily convert it to cash.
Yeah, it takes a little bit of doingness to be able to do that. So you can see you have all these buckets, and they all have certain benefits to them, and you just have to know like what you're getting. Like when you're putting money away, now in our system, we try to allocate to all three of them. And that is I think the strategy that we have is just like, let's allocate to all three of these and come up with a method in which is workable for that person. But I think at the end of the day, if you're doing your investment account, if you're systemizing your profits to that investment account, in 7 to 10 years, if you put money in all three of these things, you're not going to be disappointed. No. I don't think so. I don't think you're going to be disappointed at all.
No, I mean, time for any investment, it doesn't matter what category it falls in, having time on your side is the single most important thing.
Agreed. All right, man. That was good. We'll see you on the next podcast.